Hey everyone, and welcome to the channel. Today, we're tackling a biggie for married couples. Should you file taxes separately to manage your student loans? This question can be super stressful, and guess what? At FitBucks, we helped over 10,000 couples navigate this complex decision and find the best strategy for their unique situations. We've seen it all, from high earners with mountains of debt to couples with similar incomes sharing the loan burden. So rest assured, you're not alone in this. This video will break down everything you need to know about filing separately for student loans as a married couple. We'll cover the pros and cons, the tax implications, clever loopholes, and even some common scenarios you might face. So grab a notebook, buckle up, and let's conquer those student loans together. Before jumping into the video, please subscribe to the channel and like the video. Doing so will notify you when we release awesome new content and also help the channel grow. Most couples face this trade-off. Filing jointly saves on taxes but increases student loan payments. Filing separately lowers student loan payments but bumps up taxes. Now, let's dive into some real-life examples to see how filing separately can impact your student loan payments and retirement savings. Imagine you and your spouse have a combined federal student loan debt of $300,000 and a combined income of $150,000. Here's how your monthly payments might look under different filing scenarios. If you file jointly, your total monthly payment would be $1,098. However, this payment is not split equally. It's divided based on your individual loan balances. So if you owe 47% of the total debt, you pay $512 per month, and your spouse would pay $585. If you filed separately, your monthly payment would be based solely on your own income and debt, potentially lowering it significantly. For example, if your income was $70,000, your payment would be about $200 per month. Another consideration you need to take into account is if you file separately or your income exceeds certain limits, you might not be able to contribute directly to a Roth IRA. But don't worry. There's a workaround called a backdoor Roth IRA that allows you to make post-tax contributions to a traditional IRA and then convert those funds into a Roth IRA. I've included a link in the descriptions to a video that details everything you need to know about the backdoor Roth IRA. I'm going to discuss with you the process most people take when deciding how to file separately versus jointly. Then I'm going to share with you a loophole. Step 1 is to figure out how much more you'd owe in taxes if you filed separately. Online tools like TurboTax can help. Step 2 is to use an IDR calculator to see how filing separately impacts your estimated student loan payments. Step 3 is to compare the results and choose the option that puts the most money in your pocket. For example, say filing jointly saves you $4,000 in taxes but raises your student loan payments by $3,000 per year. Filing jointly would still net you $1,000 annually, making it the most financially advantageous option in this case. This is the easiest way to determine what you should do. I'm going to share with you an advanced loophole next. Here's a little tax trick that allows you to file separately to get a lower monthly payment as well as jointly to save in taxes. This year, file separately to lower your current student loan payments. Then in 2025 and 2026, file separately again. However, in 2026, you can reclassify your 2024 return to joint and receive a refund. You would then reclassify a previous tax return each year going forward. This loophole works best if your incomes are significantly different. Next, I'll review 3 common scenarios we see at FitBucks and share how people generally file their taxes in these situations. Let's say FitBucks member Mary makes $105,000 per year and has $200,000 in student loan debt. Her spouse David makes $30,000 per year and has no student loan debt. In the majority of cases, it would make sense to file jointly because the tax savings filing jointly should far outweigh the lower monthly payment Mary would receive on student loans if they filed separately. They could use the aforementioned tax loophole if they wanted. However, the amount of refund they get back would be minimal and not worth the accounting fees or headache in doing it. In the next scenario, let's assume Mike has an income of $120,000 and no student loan debt. His spouse Mariah earns $75,000 a year and has $200,000 in student loan debt. In this case, it generally makes sense to file separately. Typically, in this case, doing so will save his household almost $1,000 a month in monthly student loan payments. Also, if Mike's income was similar to Mariah's, then it would still make sense to file separately. In the last scenario, Brett and Sherry make $80,000 per year and each have approximately $150,000 in student loan debt. In general, it would make sense for them to file jointly because their student loan payments wouldn't drastically be different if they filed separately. Managing student loans as a married couple requires careful planning and communication. By understanding the tax implications and utilizing tools like calculators and expert advice, you can make informed decisions and navigate this challenge together. With the right approach, you can conquer your student debt and build a strong financial future as a team. Be sure to visit fitbucks.com to learn how our technology and student loan experts can help determine how to file your taxes when it comes to your loans and assist you on your way to achieving financial freedom.